Welcome. I'm Greta. I'm the Executive Director of the University of California Trust. So I would like to hand it over to our colleagues at Withers.
Thank you, Greta. That was a really great introduction, and there's not much for me to add to it. It was really helpful. I'll just say that I am US qualified. Kate is UK qualified. We work together very often and very closely on, the typical example is an American that comes to live in the UK. They think they're only going to be here a year or two, and then they end up marrying a Brit, having kids that are multi nationalities, and they still have assets in the US. They have complex trust structures set up for them in the US, and we're trying to unravel that from a US and a UK perspective. We also have families coming over as a unit and trying to kind of navigate the world of international taxation, and our goal is really to make that as comprehensive and complete as possible. Withers is a global firm. As Greta said, we have offices in many jurisdictions across the world. We have US qualified lawyers in almost all of them. One of our biggest kind of offices is definitely London, and we have what we think is the largest private client team outside of the US. And we kind of focus on the whole individual structure in terms of tax and estate planning, also business formation, family planning, family matters, kind of a one-stop shop.
And just to say, hi everyone, I'm Kate. As Maya said, I'm an associate in the private client and tax team advising on the UK side. And as Maya said, I do a lot of the work for US people moving to the UK and looking at their UK tax position once they move here, and then over the long period that they're here, and also ultimately when they leave the UK.
So we'll just do kind of a very brief overview of why all of this matters, especially if you're an American resident in the UK. The US is one of the only nations that has global taxation of its citizens. So it doesn't matter if you are not US resident, if you've never been US resident, there is still a global tax obligation on US people. The kind of common pitfalls that we have is US people are subject to special rules based on investments that are taxed punitively sometimes. The US has a series of anti-deferral regimes for putting funds and investments in non-US companies. Unfortunately, for the UK resident person, that often will capture things like UK pension accounts, kind of a stocks and shares ISA is the common one that we see that is disadvantageous for US people living in the UK. We also have very complex rules around US people benefiting from non-US trusts. There's all sorts of reporting information in respect of those. The kind of most egregious and notorious one is highlighted here, called the 3520, and that basically would require US people to report gifts from non-US individuals. And the real kicker on this one is that even if there's no US tax due on a gift, because that's kind of a fundamental principle of taxation, there's no tax due on gifts, there is a reporting requirement when that is from a non-US person and it exceeds certain thresholds. And the penalty for not reporting those types of gifts can be up to 35% of the gift. And it's just one of a highlighting just that what you don't know can be really kind of hurtful. And so we're here to kind of try and shed light on some of the common pitfalls that people might run into as they move outside of the US, and also highlight, hopefully potential solutions so that it's not all doom and gloom as a takeaway from this. And then, this is kind of just how to spot an American. It sounds very easy, and I can see some people kind of chuckling at this slide, but it's really important to highlight that Americans are, obviously like me, I was born in the US, I've come to the UK. It's very easy to spot me, but, I automatically pass down citizenship to my children who are born in the UK. And it doesn't matter if they're not registered with the embassy, it doesn't matter if they don't have a passport or a social security number, they automatically have that US connection and that US obligation. So if I was setting up some type of a junior ISA is the most common one, saving fund for them. As US people, that would be punitive tax for them and reporting. And so it's just really kind of important to realize that it's the Americans not always very easy to spot. Green card holders is a really easy one. We have lots of clients that are British, but they lived in the UK years and years ago on a green card. Green card holders have the same tax obligations as citizens. And we've had some unfortunate cases where someone said, my green card expired 10 years ago. I never formally gave it up, but it expired. So I don't, my tax obligations aren't there anymore. But unfortunately, the tax and the immigration pieces are not connected. So until a green card is actually formally relinquished, the tax liability still stays. And so a big part of what we do is also identifying that and helping clean up any obligations. My biggest fear is that someone will take away what I said and give up a green card right away. Unfortunately, an exit tax might also apply to people giving up citizenship or green cards. And that's definitely outside the scope of this webinar, but it's just to say that the American kind of taint can be present without being so obvious. And it's good to take advice on that before taking any drastic steps like giving things up or putting structures into place.
So on the UK side, the key difference really from the US is that for the UK, citizenship is irrelevant. And instead, we really look at residence in the UK. And that's residence under the statutory residence test. And one of the things that people often say when they're buying a property in the UK, they're planning to spend some more time in the UK, is they say, oh, well, I'm just going to spend up to 6 months here, but no more than 6 months, so I won't be resident. But that's not necessarily the case. The test under the statutory residence test is there are different types of tests, and it's important to go through all of them. And there can be other ties that an individual might have to the UK that could actually mean their day count is a lot lower than 6 months, and going over that day count will make them tax resident in the UK. So it's important to take advice if a non-UK person is thinking about spending a bit more time in the UK. So then looking at how that impacts tax, on the UK inheritance tax side, up until April of this year, inheritance tax was based on a person's domicile. So that was a concept that looked at where a person kind of intended to live their life permanently. But now the concept of domicile is removed for tax purposes, and instead we just look at residence and the situs of property. So UK situs property will always be subject to UK inheritance tax. But in terms of worldwide property, an individual will only be subject to UK inheritance tax on their worldwide property once they've been UK tax resident for more than 10 out of the preceding 20 tax years. So you have 10 years of residence in the UK before falling under the scope of worldwide inheritance tax. But once you go over that threshold, then all of your assets worldwide come within the scope of UK inheritance tax. On the income and capital gains tax side, any UK income and UK gains will always be subject to UK income and capital gains tax. For the first 4 years of UK tax residency, we have a new regime which started in April of this year called the Foreign Income and Gains Regime, also known as the FIG regime. Foreign income and gains is shielded from UK tax for the first 4 years of UK tax residency. So you do have to claim relief under the regime. So all of your foreign income and gains does need to be reported to HMRC, but it doesn't need to be taxed. After 4 years, worldwide income and gains is taxed in the UK. Just a couple of other points on this slide to keep in mind when coming to the UK is that for trusts, the UK will view trust residency based on the trustee's residency. So if a trustee moves to the UK, that could bring the trust into the realm of UK reporting and taxation. And then on the company side, for non-UK companies, we look at where the company is centrally managed and controlled. So if the majority of directors or a key decision maker in the company becomes UK resident, that can bring the company into the scope of UK corporation tax.
I think kind of a big takeaway from this slide is that the FIG regime is really great for individuals. It's less beneficial for Americans who are subject to worldwide tax anyways, but I feel like it can also cause a bit of a false sense of security because Americans come over here and think I have 4 years to sort everything out. But if they're trustees of trusts, if they're managing companies, those entities are not protected under the FIG regime. So even though the individual might not have a UK income tax liability, they could bring those entities within the scope of UK taxation. So the real kind of key is there's still pre-immigration advice is still really crucial to make sure that we're not bringing kind of other sources of income that might otherwise be protected from UK taxation within the net unknowingly.
Yeah, and to add to that, because our tax year it runs from 6th of April to 5th of April, and typically tax residency will be for the entire tax year, it's always best to take advice as soon as possible and preferably before the April of the year of moving to the UK, so that any arrangements that need to be put in place can be done before the tax year that you move to the UK begins.
So, Kate, I have a lot of clients who have learned about this long-term residency test, the 10 out of 20 years, and they're saying they're going to get out of the UK. Are they automatically free of IHT?
No, so if they have property in the UK, then that property will still be subject to UK inheritance tax. There are circumstances where the US-UK tax treaty can change that position and give primary taxing rights to the US, but generally the position will be if they have any UK property, that will be subject to tax. There's also a tail to the 10-year period. So, and if you've been in the UK for 20 years, then that tail can be as long as 10 years. So even if you leave the UK after, say, 10 years of residency, then that tail is usually 3 years. But you will still be within the UK inheritance tax net on a worldwide basis for a few years after leaving the UK.
Yeah, there's a position on the under the US UK estate tax treaty, which we never really had to look at before, but it essentially will allow the tail to be shortened if you go back to the US and kind of reacquire your US domicile. And the idea is that under the terms of the treaty, it basically takes the tail away. The one kind of asterisk there is that that doesn't apply to UK citizens. It's just the plain language of the treaty. So we've had clients come to us before and say, should I take out UK citizenship? Is there going to be a tax disadvantage? And previously, there was never an issue with UK citizenship, but now we have to caution that that would prevent them from taking advantage of this treaty if they were going to move back to the US and look at kind of shortening or completely breaking their tail.
To give you some more detail about the taxes, so UK inheritance tax is at 40%, so the rate is the same as in the US. But our nil rate band amount, so the amount that's not subject to tax, is much lower. Currently, it's at 325,000, which is obviously significantly lower than the US estate tax exemption. We do have an additional exemption amount where a personal residence is left to children or grandchildren. That's only available where the entire estate is at a value of less than 2 million. But that together with the transferable nil rate band, which you can transfer the nil rate band from a predeceased spouse, can bring the total exemption up to 1 million. So still quite a lot lower than the US estate tax exemption. Other exemptions that we have the spouse exemption. So where assets are transferred to a surviving spouse. However, for the UK purposes, the spouse's status as long-term residents need to match. So either both spouses need to be not long-term resident in the UK, or they both need to be long-term resident in the UK for you to get the full benefit of the spouse exemption. We also have a charity exemption, so any assets that are left to charity can pass free of inheritance tax. And if an individual leaves 10% of their estate in value to charity, which needs to be a UK charity, then the tax rate on the rest of the estate is reduced to 36%, which can be quite a significant benefit. And finally, we have business property relief and agricultural property relief. So where an individual owns a business or has agricultural property assets, those currently can pass completely free of inheritance tax. However, from April next year, so 2026, the rules are changing to reduce that relief by half. So any business property assets and agricultural property assets will now be subject to IHT at a rate of 20%.
So as Kate alluded to, the US estate tax exemption amount is much more generous. We have, for just to caveat, I'm only talking about federal tax in this case. California doesn't have the state estate tax, but some states such as New York do. So I'm purely talking about the federal exemption amount. It's currently 13.99 million per US citizen or domiciliary. It is under the 2025 Tax Act. It has now gone up to 15 million permanently indexed for inflation. The thing to keep in mind is there is a marital deduction typically for assets being passed between US citizen spouses. But if the recipient is not a US citizen, and that includes US green card holders, the marital deduction does not apply absent specific estate planning. So that's kind of where you would be looking to your estate planning lawyer to put in specific marital trusts in place to make sure that there's no tax due on the first death. Especially when you have a UK kind of IHT liability, it also makes the taxing event at the same time, which will optimize credits between the two jurisdictions. Another common theme that we see is people in the UK acquiring US property. That's either US real estate, US investments. Sorry, Kate.
Sorry.
No, that's great. The exemption amount for non-US people with US situs assets is only $60,000. That's not indexed for inflation. That's just the permanent amount. That can be quite a tax trap for people unknowingly, especially if you have a mixed nationality marriage. I've seen people where the breadwinner is British, not American, so they put all of the assets in that person's name, not knowing that they've actually just totally reduced the exemption amount for them. There are provisions under the US-UK estate tax treaty which can help this, especially in regards to investments. Those would be exempt from US estate tax if the person is otherwise domiciled in the UK. But the thing to kind of highlight there is that it would still create a US estate tax filing requirement. And if the executor of the estate is not a US person, it would require an IRS transfer certificate to have the funds released. Everyone knows that the IRS is inefficient. They're particularly going through a tough time right now. And I'm currently in 2+ years waiting for a transfer certificate for some funds to be released. There are kind of planning ways to get around that. Typically, appointing a US executor will help. But it was a really unfortunate tax trap for this client because tax is not due under the treaty, but just the way that the financial institution will release the funds without a transfer certificate from the IRS, we've got a real kind of asset cash freeze liquidity problem, and there's no way to speed it up. So it's just another one of these things to keep in mind when you're doing your planning of how like real world kind of bureaucracy can really tie things up even in the absence of a taxable event. And the tax rate is 40% in the US and the UK, which is helpful because usually credits kind of offset any tax double taxation, as long as kind of I alluded to the taxing event is the same. So how can we help? Part of what we do is wills and estate planning. I think I mentioned before, if you have kind of a multinational couple where my husband is British only, so I would need to, if I had the money where this is relevant, I would need to put into place special kind of tax planning and strategies to make sure that we have an efficient kind of transfer of assets to prevent tax due if one of us were to pass away. I think the biggest kind of shock realization event when I'm talking to clients is that the spouse exemption, and particularly in the UK where the nil rate band is so low, doesn't apply automatically. And maybe Kate can talk to that.
Yeah, so Exactly that. So especially if you're passing assets from someone who's within the scope of worldwide IHT to someone who's not within the scope of worldwide IHT, then you wouldn't get the full UK spouse exemption. And then on the flip side, as Maya said earlier, you wouldn't get the full marital deduction if you're passing assets from a US citizen to a non-US citizen. And what we can do is put specific language in the will to provide for the spouse, but via a specific type of trust. That means that you do qualify for those exemptions. So that's how we can kind of input into the will and make sure that planning is there so that tax is essentially deferred until the second death. Also, another point that often trips people up is that they think that even if they don't have a will, all of their assets will pass to a surviving spouse. And that is not the case in the UK under our intestacy rules, so the rules that apply if you don't have a will. The spouse is essentially only entitled to half of the assets if there are surviving children. And then so the assets are split half to surviving spouse and half to children, which not only is probably not what the testator wants to happen, they probably want their assets to pass their spouse, but also isn't very efficient from a tax planning perspective, because it means that spouse exemption will only apply on half of the estate, and on the other half that's passing to the children, there will be tax to pay immediately.
Another kind of thing that we always flag when we're doing wills is powers of attorneys. A lot of times people will, especially in the example where we have the couple moving from the US to the UK, they have their California documents in place. They've done everything right from a California perspective. They don't always realize that those don't work in the UK. They're very jurisdiction specific. So we would always recommend that, there are UK kind of power of attorneys put in place for health, welfare, financial decisions. They need to be they're quite specific documents. Kate is nodding because they're very precarious. But it's just a kind of a tidy thing to do at the same time if we're looking at type of estate planning.
Yeah, and just on the wills point, what we can do, we can either do a will that covers both the US and the UK, so all of a person's assets wherever they are, or if a person has planning already in place for their US assets, then we might look at just doing a UK will for their UK assets. That might be the best approach, but we'd have to look over to see kind of what the estate plan looks like just to make sure that it doesn't conflict with anything that we want to do in the UK. But often that is something that clients look to do, is to have two separate wills.
I think we can. So I wanted to flag this one quite on its own because everyone in California puts all of their assets into a California revocable trust for probate purposes, totally tax neutral from a US perspective. It's the smart thing to do. If you move to the UK with that type of trust in place, it can be really punitive. So one of the first things we talk about with people is what have you done in the US and what does it look like? And please, can we see it? Oftentimes there are ways to get comfortable with it, but sometimes not. And the real reason, perhaps Kate can talk about is how trusts are taxed quite punitively in the UK. We don't have this, I say we as if I'm a Brit, but there isn't the same kind of tax neutrality as a given for trust structures.
Yeah, exactly. So typically when a person is setting up a trust in the UK, there will be a inheritance tax charge when the trust is set up. So that's at 20%. We call it an entry charge, those assets going into the trust. Often if a person has set up a trust when they're completely outside of the UK, then that wouldn't apply. But it is just something to be aware of if you have come to the UK, but are speaking to advisors in the US, maybe about trusts that you might want to put in place. But then we also have ongoing trust charges. So there is a 6% charge on every 10-year anniversary of the trust, which is the main tax charge that puts people off of creating trusts, because not only do you have the initial tax, but then you have this ongoing taxation, which wouldn't apply if you just kept the assets in your own name. The trust assets won't necessarily be considered outside of your estate for UK inheritance tax purposes. So in some situations, putting assets into a trust will take it out of that 40% charge on death. But in many situations, that is not the case. And so you can end up in a situation where you're paying the 6% 10-yearly charges as well as the 40% charge on death.
A lot of times we'll have people that come to us and they are the trustees of their parents' trusts, or they're going to benefit from their parents' trusts. And we kind of flag the first issue if you're a sole UK resident trustee of a substantive trust, that you could actually be migrating the trust into the UK tax net and kind of creating UK tax exposure on the whole trust. But also if there's a substantive trust in the US, the way the taxation rules work between both jurisdictions, it's very difficult to line up distributions so that the foreign tax credits match between the US and the UK to avoid a double tax charge. And that's particularly where we get involved and look at the trust documents and say, how can we optimize this? Maybe we have an income interest and maximize foreign tax credits. Maybe we skip your generation and put assets into a children's name to kind of remove a level of inheritance tax on one kind of generation. So there are lots of ways where we can get involved. It's better usually almost always when the grantor, the trust creator, is still alive, and we can kind of play with the documents a little bit. But there is, I think, value in looking at a trust in any event. We have on the next slide kind of this Rubik's Cube of things to think about. And it's right in the middle where I'm talking about trust. And I think maybe right now would be a good time to talk about the estate tax treaty. I don't know if you agree, Kate, but before the rules changed last year, there used to be something called an excluded property trust, where someone who was not UK domiciled could set up a trust with non-UK situs assets and essentially ring fence those assets from UK inheritance tax. The budget kind of got rid of this planning and made it really punitive for anyone to set up trusts while they're in the UK. But we've been looking at the US-UK estate tax treaty in a way we never have been before. And we think that there is a comfortable position that if someone sets up a trust under the right circumstances with the right kind of caveats and restrictions in it, we can essentially kind of replicate this excluded property trust. The real benefit of that is it would preserve kind of the delta between the UK exemption amount and the US exemption amount, that 15 million versus 325,000 pounds. So the best kind of example scenario for this is someone that is moving to the UK, but they have loads of US real property or loads of investments still in the US, and they don't necessarily want to bring that into the UK tax net. At that point, if certain conditions are met, we do still think that there's a way to essentially ring fence that from inheritance tax. But the planning window is much smaller than it used to be. So the real emphasis on that is to do kind of pre-immigration advice or advice as soon as you move to the UK to see if the treaty is actually still available. I don't know if you had anything to add, Kate, on that.
No, that's exactly right. The budget that last year's budget made a lot of changes to UK inheritance tax, like changing from domicile to a residency regime that I spoke about earlier and introducing the FIG regime. And this trust planning is something that has come out of that budget that we're happy to look at new solutions for clients.
Yeah, that's another one where also having UK nationality might be punitive. This planning doesn't really work for people that are UK citizens. So it's another thing that we would have to keep in mind.
Yeah.
Sorry.
I was just going to say on that point, on the UK citizenship side, if you do have both US and UK citizenship, it's not necessarily the end of the world, because UK citizenship is a bit easier to kind of lose than US citizenship. So we have spoken to clients about relinquishing their UK citizenship especially if they're planning on leaving the UK. But then you have to think through the immigration implications of that as well.
You can only give it up once though, I think, right?
Yeah. Yeah, you can apparently give it up once. and reacquire it, and that's quite straightforward as long as you meet all of the necessary requirements. But then giving it up a second time is apparently quite difficult.
Another kind of thing to keep in mind is the rules on the sale of a primary principal residence are different. The US has worldwide income tax on the sale of a property. You have a limited $250,000 exemption on gain, but it's different in the UK.
Yeah. So where you are selling your main home, in the UK, we have an exemption called the Principal Private Residence Relief, which completely relieves any gain on your main home from capital gains tax. So typically when people sell or gift their main home, they will not pay any capital gains tax, and the value of the property will be rebased to the value, if it's a gift, to the value at the day of that gift.
So a common planning tool is if we have a US and a non-US couple owning property, we use our gift exemption amount potentially to shift equity into the non-US person's name, so that if there was a sale of a highly appreciated property, we could limit the US capital gains tax exposure and then have that tax-free from a UK perspective. So when we have people coming to us asking how they should take title in a property, we often say maybe tenants in common would be a better way to do that than the typical joint tenants with right of survivorship. But I think at that point, the will becomes important, right, Kate?
Yeah, exactly. So if you own property jointly, essentially if you own property with another person in the UK, there are two different ways that you can own that property. You can either own it jointly, which means that when one co-owner dies, the property will automatically pass in full to the surviving co-owner. That's called the rights of survivorship. That means that the property won't pass under the will, and that might be completely fine, and is quite a simple and straightforward way to own property. But often we look at owning the property as tenants in common, because that means that then when one co-owner dies, their interest will pass via their will. And especially if we've put a lot of thought into the will and done careful planning to make sure that the inheritance tax and the estate tax exemptions all line up, we actually do want that property to pass under the will. So if the property is owned jointly, then we can look at severing that tenancy so that the property is actually owned as tenants in common instead.
Thank you. I think the other thing I wanted to flag is that LLCs are treated differently in the US and the UK, and that can be quite a surprise when people move over to the UK. They are most of the time, unless a special classification has been made in the US, tax transparent from a US perspective, treated very much like a partnership where the income and gain kind of flows through as it arises. But the position is different in the UK, I understand.
Yeah, so in the UK, we tend to look at LLCs as opaque entities, so being their own entity for tax purposes. And so this mismatch means that foreign tax credits on the income and gains generated by the LLCs probably won't line up, and they'll be taxed differently, so you can end up having double taxation.
The other kind of planning thing that we see a lot, which isn't on this slide, unfortunately, but it's just life insurance. A lot of people, especially now where the inheritance tax threshold is so low, are taking out life insurance to kind of plan for liquidity. It's just important to flag that if that's not in a properly structured trust for US and UK purposes, the value of the payout will actually be includable in the estate and subject to tax. But if it's in a properly structured trust, and I know we've said trusts are bad from a UK perspective, but we can make them work with life insurance policies most of the time. Those are protected from inheritance tax and estate tax. So it allows basically the whole policy to come out free of tax. There are special rules with how the insurance policy should be acquired from US perspective. For example, we should set up the trust and have the trust buy the policy rather than transferring an already existing policy into trust. But there are ways to make that a really efficient tool if a family is just saying, I'm going to have loads of tax. but I don't have the cash to pay it. So insurance is a really common one.
Yeah, and that can be insurance that's whole of life, so will pay out on death, or it can be term life insurance. So if someone's, say, coming to the UK, but they think they're just going to be here for 5 or 10 years, then you could take out life insurance just to cover that period that you're going to be within the UK inheritance tax net. And that can be a cheaper option for people who are planning on leaving the UK.
So this slide, we just talk about some kind of common giving, lifetime giving kind of concepts to keep in mind if someone is trying to transfer wealth outside of their estates during lifetime. It's common to call this an estate freeze, because essentially you're transferring assets outside of your estate for US estate tax and inheritance tax. And if it's done properly, it allows the assets to grow and appreciate completely free of estate tax in your own name, so passing the wealth kind of down a generation. There are simple ways to do it is just outright gifts. The US, you have your 13.99, almost $15 million exemption amount. You can also make gifts to, currently it's $19,000 per person per year to anybody without having to file any type of gift tax return. And then what we're commonly doing is using this, it's on here, the $190,000 exemption amount for gifts to a non-US spouse to transfer a little bit of wealth outside of your name. Usually we see that in the context of interest in property. If we're trying to make really big kind of gifts using the whole 13.99, $15 million exemption amount, the common way to do it in the US is through the use of trusts. We can't really do that if you're a UK resident. So we've seen a real shift lately to using partnerships. From a UK perspective, you can structure it so it works from a US and a UK perspective to shift assets outside of the estate and pass wealth down to the next generation. It's similar to a trust where it allows the economic contributor to maintain some type of control management over the assets, but shift the actual value to the next generation. So it's quite a useful tool if we're looking at estate planning and trying to reduce kind of the estate at the current generation where the wealth has been accumulated, passing it down to the lower one, but without giving kind of full reign to children, usually in this case.
And just on the UK side, in terms of gifting, individuals who are not long-term resident will not have any IHT exposure on transfers of non-UK property. But if an individual is long-term resident or is transferring UK property, making a gift of UK situs assets, there still won't be any inheritance tax immediately. Inheritance tax is only due if the donor dies within 7 years of the gift. So we call gifts potentially exempt transfers because essentially when you make them, they might be exempt from inheritance tax, but you've sort of got to wait 7 years to see if they fall out of scope of IHT. And there's a tapering effect to the IHT rate. So if you die within 3 years of making the gift, it will be the full tax rate of 40% on the gift. But as you get further and further away from making that gift, the tax rate reduces up until you survived the gift by 7 years, at which point there's no tax. We also have an exemption which is quite valuable called the normal expenditure out of income exemption, which is where gifts are made out of a person's income. So regular income, they can make gifts out of their income, they still retain enough income to support their normal standard of living, and they make those gifts fairly regularly so that there's a pattern. Those gifts are not subject to the potentially exempt transfer regime. So even if you die within 7 years of making those types of gifts, there won't be any IHT. A key difference on the UK side as well that we've kind of touched upon is that a gift will trigger UK capital gains tax, and that tax is calculated on the basis of the market value of the asset at the date of the gift. So that's a difference to the US where you wouldn't get capital gains tax on the gift. And it means that going forwards, there'll be a difference for the recipient's base cost. So if they then sell the asset, there'll be a different amount of tax due in the US and the UK because the gain is different. So there just might be more tax to pay in the US because the base cost is probably going to be lower.
There's a real risk of kind of double taxation in that case where you have that basis mismatch because there's no offsetting credit later on for the UK CGT that was paid at the time of the gift.
Yeah.
I always feel like it's the UK system is touted as being so generous because you can gift away whatever you want and survive it by 7 years. But that kind of capital gains tax charge on anything that's appreciated, I feel like can be a real dry tax charge that people don't always appreciate being an issue.
Yeah, definitely.
And Kate, there's a budget coming up next month. Is that good? Are any of these rules going to change? Do we know?
We don't know. There's been talk about potentially changing the potentially exempt transfer regime, so increasing that 7-year period possibly to 10 years. There's also always talk before a budget about changing the capital gains tax rate. So at the moment it's 24%, but it's possible that that might be a tax rate that increases. But we haven't heard anything definitive. Before last year's budget, we had quite a good idea about what they were going to say and the changes they were going to introduce, whereas this year we've just heard rumors but nothing really definitive. We're kind of waiting to see what happens. The budget is on, I think it's the 26th of November, that will be announced. So we'll wait and see what happens then. We're not expecting any huge changes, but we just don't know at this stage.
Do you have any clients accelerating gifts at the moment?
Yeah, absolutely. Yeah. So we're doing quite a lot of work with clients who are thinking about making gifts and thinking that because of the capital gains tax rate potentially being increased and potentially because of changes to inheritance tax rules, they're thinking about making those gifts earlier than November, so that they get them done before the budget. Like Maya said, we're doing a lot of partnership planning. And because setting up the partnership, when you transfer the partnership interest to your children, that is considered a gift from UK tax purposes. So we're doing quite a lot of partnership planning at the moment, setting up partnerships and funding them before the budget.
Good to know. I think I appreciate we've been talking tax for 45 minutes. We've got one more slide on charitable giving. And that's kind of to highlight kind of how the rules are a little bit different again in the US and the UK. When we're talking about estate planning and testamentary documents, a lot of clients like to make provision for charities in these documents, either as part of their overall plan for where their estate should go, or as kind of like a backstop. And it's this kind of, in case there's no one to benefit from my estate, it all goes to charity. The rules on what is actually a charitable deduction are different from the US and the UK. The US doesn't have a territorial arm with bequests left to charity. A UK charity will qualify for the US charitable deduction as long as what is actually in the will itself is ascertainable. We can't kind of say, I want everything to go wherever my trustees decide for them to go, and then the trustees decide that they go to charity. That's not enough. It has to be kind of a testamentary intent by the person writing the will, how much is going to charity. But we are more generous in the sense that you can leave your assets to a UK charity and get a US charitable deduction.
Yeah, whereas in the UK, we do have the flexibility in terms of you can leave it up to the trustees to decide which exact charity to give your assets to if you'd like to. But it does have to be a UK charity. So that's quite a bit more restrictive than on the US side. And just as I said at the beginning earlier on, a gift of any amount is free of inheritance tax. And then if you gift 10% of your estate to charity, that will reduce the tax rate on the rest of your estate to 36%. And often when we're talking to clients about this, they're kind of thinking about making a gift of 4 or 5%. And I think the threshold is 4%, that if you're thinking of making a gift higher than that, you might as well make a gift of 10% to reduce the tax rate on the rest of your estate, because the beneficiaries will ultimately receive the same amount. So often a lot of clients will do that, and we can draft the gift in a certain way so that if these rules were to change and that reduced tax rate was no longer available for some reason, the gift wouldn't take place, or a gift of a different amount would take place instead.
And on the income tax side, the US is territorial on how you can get an income tax deduction for a charity. In that case, it has to be a US qualified charity that is established in the US. And I think it's the same in the UK, Kate, right?
Yeah.
So what we've done, what the University of California has done is there are many kind of charities which have created kind of this dual qualified structure, which through various US tax elections means that the US charity owns the UK charity, and any gift to the UK charity is basically treated as a gift to the US charity for US purposes, but the UK charity for UK purposes. It's more complicated than that, but for kind of this giving in the UC Trust sense, it works. So you get a deduction in the US and the UK, and that's where the real benefit is so that you get the benefit in both places where tax is due, and then with, you know, credits being available for other income tax liabilities, it creates the most optimal tax position without too much leakage. There are other dual qualified charities that are kind of like donor advised funds where you can kind of direct income to go. Charities Aid Foundation is one of the most prominent ones, and it's also another way to make tax efficient charitable giving for the US and the UK. Yeah. And that is us. If anyone has any questions, we still have some time. I think, Lynn, do you have a question?
Yes, hi. Thank you for this excellent presentation. I'm a director of gift planning at UCLA, and I work with Matthew Daines, who is regional director of development for the UK and Europe. And Matthew and I are in the process of developing sample bequest language templates for his use with donors. And you just brought up a point, Maya. I guess my question has to do with, as a gift planner, I'm leaving the actual structuring of the estate plan to practitioners like you and Kate, but I do need to provide sample language to Matthew and to other donors that may come up from the UK and Europe. So what is your recommendation? Are we to have dual language in there for the UC Trust and the UCLA Foundation, or the Regents, or what is that supposed to look like from a practical standpoint?
I mean, from a practical standpoint, it's whichever one is qualified to receive a UK charitable deduction, which I think is the UC Trust, because this is what you need for UK inheritance tax purposes.
Okay.
And then,
And
sorry, go ahead.
within that, if we're directing it towards a specific program or fund, we put that language in there after directing it to the UC Trust. Is that right?
Yeah, absolutely. The typical way that it's drafted is, you know, I leave this much to UC Trust with my fond hope and desire that it's used for this program at UC Davis, and you know, you kind of work that way.
Okay, good. Now, a couple other questions from that. At UCLA, we use testamentary pledges to some degree, and I was wondering how those documents and endowments are looked upon in the UK. Is there, you mentioned that revocable trust are looked at a little askance. What about testamentary pledges or making endowments within sample bequest language?
I haven't had to look at that before, so I'd probably have to take a look at it to see how it would work. I think when it's outside of the will, it would probably be dealt with slightly differently.
Okay. All right, so that's case by case basis is what you're telling me. Okay.
Yeah.
Thank you.
I have a question.
Okay.
Yep.
Yeah, can you go back to the slide that talked about normal expenditure exemption?
Yeah.
And I just had a couple questions about the normal expenditure. It
Mhm.
sounds like record keeping is really important, so that's one.
Yeah.
And the other is, how does one prove that you're not compromising your standard of living? That seems very like
Yeah.
wishy-washy to me.
No, you're absolutely right. Record keeping is crucial for this exemption, and HMRC has been known to look through bank statements and records of expenditure in order to determine that this exemption can apply. I think what we always advise clients to do is to be cautious and always to leave a buffer, not to pay out all of their surplus income. Essentially, what we usually end up doing is doing a calculation of how much income someone has, what their typical expenditure is, and then looking at the surplus and using a part of that surplus. We would never recommend using all of it to make gifts, just because that's integrally more high risk. But looking at how much that surplus is and where gifts can be made. But you're absolutely right that records are very important. We usually recommend doing some kind of letter to the recipients to say, I'm planning on making these gifts out of my income. And establishing a pattern is also important, which is where the documentation can also be really helpful.
Oh, thanks. Could you say a little bit more about what satisfies the tax office about not, breaching the threshold of standard of living?
I mean, it is a case-by-case basis. HMRC has pretty can ask questions about anything. They can look at as much documentation as they want to. And it's really up to the HMRC inspector as to kind of what they'd want to ask for to look at. They wouldn't want, they would essentially want all of your normal expenses to be able to be covered. There shouldn't be any kind of change in your normal day-to-day expenses just because you're making the gifts. But it's something that we do look at quite carefully, so it's difficult to kind of say exactly where the line is, just in general.
Hey, is there a filing requirement? Do you have to file to HMRC when you make this type of gift?
So you only have to file if those gifts add up to, I think it's 80% of the nil rate band. So 80% of 325,000. Once you get up to that amount, then you have to file and claim the exemption.
So are you saying that before that it's a little bit more murky?
Yeah, exactly. But if you're under that level, then you can keep making the gifts, and HMRC there's no requirement to report them to HMRC unless you die, at which point your executors are required to report gifts and make a claim for any reliefs that may apply. But you're in a slightly more difficult position because you can't guarantee that that exemption is going to apply, and you won't get HMRC's approval to it.
Yeah. And when it talks about income, it's any income, right? So it could be interest income and
Yeah.
normal income. So there's no restriction on the kind of income.
No, there's no restriction on the type of income.
Oh, okay, great. And I can waive for someone else's question, but I'm not very clear about the next one, which is gifts can trigger UK capital gains tax. Is it possible just to sort of give an example?
Sure. So say I owned maybe a painting. If I then made a gift of that painting to Maya, then if the painting had increased in value since I purchased it, then I would pay capital gains tax on that gain. So I would calculate the gain based on how much I paid for the painting against its market value on the date that I give it to Maya, and I owe tax on that gain. And then Maya would take the painting at the base cost of the date of the gift.
I think that the point that we wanted to make there is, let's say the painting was purchased by Kate for 100 and she gave it to me when it was 150. So she pays tax on that 50 gain. And I take it as a basis of 150 for UK purposes, but I'm also a US person. So for US purposes, I take it with the original gain of 100, so that when I sell it and it's worth 200, then I have 50 gain in the US, excuse me, 50 gain in the UK and 100 gain in the US. And there's no tax credit for what Kate paid originally for that appreciation. So there's a real risk of double tax essentially on transferring those appreciated assets when the donee is also US, UK.
Gotcha. That was really helpful. Thank you.
No problem.
I have a question. Thank you guys so much for this. It's really helpful. Also, everyone's questions are really helpful. My question is, so I'm a US UK citizen, not planning on leaving the UK. Parents in the US, in California, they've put things in a trust. And I'm just wondering, it's so much. All of this is so much to sort of take on and unpick. What would be next steps in getting individual advice, and what would be sort of costs associated with getting that advice and making decisions as you go? Because it is a minefield. It's a minefield.
It's really difficult. It's hard for us to kind of say what costs are. It's very
Sure.
fact specific, but our first port of call would be to look at what the trust is from a UK perspective. Most of the time they are what the UK considers bare trusts, which is not a substantive kind of settlement. And so that would be a preferential starting point where during the life of your parents, it's not an actual substantive trust, just because the way that the rules work in the UK, and Kate, please tell me if I'm going in the wrong direction. I'm speaking outside of my accent, but if it's a bare trust during your parents' lifetime, we're not worried about what type of accumulation is going on within the trust. It's essentially neutral from a US and a UK perspective. And then what we really worry about is at the time that the proverbial bus comes for your parents, that's when it's a substantive trust. And we're worried about the income and gain accumulating at that point and how we get the assets out to you.
Yeah.
And make that tax efficient. It might be just that, your parents decide that you are ready to receive everything outright, and that is tax efficient because there's no inheritance. There's no tax on an inheritance from a US or UK perspective if what's coming out is really principal trust corpus. If we're talking about loads and there's asset protection kind of things to consider, and they want to keep assets in trust, that's where we need to look at how we make sure that what's taxed in the UK will be offset by a credit in the US, and that we can kind of prevent a tax leakage. If you have children, also what we would think about is maybe what we do is you don't need the money from your parents. What we want to do is protect that for the next generation. So how can we bypass your level? And so that if you pass away with this outright, you don't have a 40% IHT charge, and we kind of create kind of the nest. But I think the starting point is looking at what is this trust right now?
What is it right now? Yeah.
How can we optimize it? And also what kind of assets are we dealing with? If it's real property, it's harder necessarily to unpick. If we're talking about cash and investments, there's more flexibility.
Okay. So, and literally, are we able to reach out to you guys to sort of do next steps as part of this, just to see what?
Yeah.
Thank you.
Our email addresses are on this slide. So you're welcome to take them down. And I don't know, UC might be circulating these slides. Yeah, you will be. So you'll have our contact details there.
Thank you.
Yeah. And I don't know if there are any more questions or if we should end here.
I just had one question. I don't know, Maya and Kate, thank you so much. I know you can't really talk pricing because obviously everything is very dependent on probably what you're looking at, documentation, but kind of ballpark for, let's say, and I'm kind of in the same as Sam. I live in the UK now, but my parents are in California, and we don't kind of intend on going back to California. Very middle class, a trust, and some investments, not talking in the millions, but probably in the hundreds of thousands. What's kind of the ballpark range when you look at assessing something like that? Are you talking about, I don't know, is it 5,000, 10,000, kind of what's the generic kind of figure? I'm not looking at specifics, but just kind of very generic to kind of understand what the cost structure would look like.
Yeah, I mean, we're like any other law firm. We charge on an hourly basis, and based on our hourly rates, we always kind of staff things as appropriately as we can to mitigate costs. But as a starting point, we would probably be looking at £5,000 to review a trust and kind of come to an understanding of what it is for UK purposes. I'm very nervous saying this while this is being recorded and will be circulated because it's all facts, circumstances, and if someone comes to me with something that is very, complicated and complex, then I do not want to be bound by this fee estimate. I mean, there's no elegant way to say that, but it's just so fact specific, but that would kind of be a ballpark range.
No, I appreciate that. Thanks so much.
Yeah. Well, it looks like that might be it. If anyone wants to reach out to us, we would be very pleased to take forward discussions. We don't charge for initial calls as scoping and kind of seeing what we can do. So we'd be happy to kind of take that on if anyone has any questions. Great.
Thank you so much.
Thank you.
Yeah, thank you all for coming. And yeah, I think the recording and the slides will